Welcome to The Explainer. I'm absolutely thrilled to have you here today because we are tackling one of the most fascinating intersections in modern finance. Today, we're going to bridge the gap between Bitcoin's underlying technical foundation, the raw absolute code and computer science that makes it tick, and the massive multi-billion-dollar market movements we're seeing right now. Whether you're wondering how a digital coin actually works or why Wall Street is suddenly pouring hundreds of millions of dollars into it, you are in the exact right place. So let's dive into this.
Here's our roadmap for today. First, we'll cover the blockchain public ledger, then mining and proof of work. Third, solving the speed problem. Fourth, the ETF market shift. And finally, we'll look at the key price levels ahead.
All right, part one, the blockchain public ledger, reimagining the bank.
So what exactly is a blockchain? At its core, it's a decentralized public ledger. It basically records every single transaction in linked, permanent blocks, completely without a central authority. If we really want to understand the wild market swings and why Wall Street cares, we first have to grasp this underlying engine. It really requires us to reimagine what a bank actually is. You see, unlike a traditional bank, where a single corporation holds a master ledger on a private, hidden server, Bitcoin's ledger is shared across a massive global network of computers. There's no CEO, no central server, and no government controlling it. Every transaction is permanently etched into a block, which is then literally chained to the previous one.
Think of your everyday interaction with this ledger in two simple parts: your public address and your private key. Your public address is exactly like a standard bank account number. You can hand it out to anyone to receive funds. But your private key, that acts as an incredibly secure, super secret digital password. You use it to mathematically sign and authorize your spending. And the real beauty here is that the network can instantly verify your digital signature without ever needing to know your actual password. Pretty amazing, right?
Moving right along to section two, mining and proof of work, which is all about securing the network. Let's walk through the actual life cycle of a transaction. Step one, you, the user, send some Bitcoin. Step two, the computers on the network, we call those nodes, immediately jump in to verify that you actually have the funds and haven't tried to pull a fast one and double spend them. But step three is where the real magic happens. Miners, which are essentially just massive, high-powered computer systems, compete to solve a highly complex mathematical puzzle to find a random number called a nonce. Think of it like the world's most difficult game of Sudoku. Guessing the right number is incredibly hard, but checking if the answer is right, that's instant. When combined with the block's data, this produces a unique digital code known as a hash. The first miner to find the right hash gets to step four, permanently adding the block to the chain and earning some newly created Bitcoin as a reward. This entire massive computational marathon, that is what we call proof of work.
To really grasp the sheer bulletproof security of this setup, consider this. If an attacker tried to change even a single transaction in the previous block, this would completely change its hash, breaking the link to all the subsequent blocks. So the absolutely crucial takeaway here is that this cryptographic link makes the entire ledger completely tamper-proof or immutable. To cheat the system, a hacker wouldn't just have to alter one block. They'd have to redo that massive proof-of-work marathon for the altered block and every single block that came after it, faster than the rest of the honest network combined. Practically speaking, it's impossible.
Okay, section three, solving the speed problem with the Lightning Network.
Now, this level of fortress-like security is amazing, but it definitely comes with a trade-off. Because the main chain requires global consensus and intense computation, it can only process a limited number of transactions per second. So when the network gets busy, fees can absolutely spike. But developers created a brilliant solution called the Lightning Network. It acts as a second layer built right on top of Bitcoin. It enables users to execute incredibly fast, super cheap transactions off the main chain. Basically, you can open a tab, make hundreds of microtransactions instantly, and then only when you're completely done, the final net balance is securely recorded back down on the main blockchain. It essentially gives you the speed of swiping a credit card, but with the ultimate security of Bitcoin's base layer.
So here's the million-dollar, or maybe billion-dollar question. Why does this highly technical, tamper-proof design actually matter to Wall Street? Why are the biggest financial institutions in the world suddenly so obsessed with cryptographic hashes and Layer 2 networks?
Let's get into section four to find out: the ETF market shift and institutional adoption. $8.2 billion. That is a massive number. This represents a staggering 8-week streak of institutional outflows from spot Bitcoin ETFs that recently, quite frankly, crushed market sentiment. For over 2 months, large institutional investors were just pulling their capital out, putting immense downward pressure on Bitcoin's price and making the broader market feel incredibly cautious. But then, out of nowhere, a dramatic reversal.
$265.7 million. That was the sudden, single-day net inflow into spot Bitcoin ETFs that definitively snapped that massive outflow streak. This was the strongest single day of fresh investment the market had seen since early May. It proved that institutional demand hadn't just vanished, it was really just sitting on the sidelines, waiting for the exact right moment to jump back in.
And, this trend isn't operating in a vacuum. While Bitcoin ETF inflows hit their highest point in months, that momentum actually spilled over to other assets like Solana. Spot Solana ETFs also saw a major reversal, with the Bitwise BSOL ETF attracting over $8.3 million in fresh capital. This is a huge signal. It points to a broader return of institutional confidence, showing us that professional buyers are treating these recent price dips as highly attractive valuation floors. We are literally watching the market transition in real time, shifting from cautious defensive selling straight back into strategic accumulation.
Which brings us to our final part, Section 5, Key Price Levels Ahead and Analyzing the Rebound. Right now, we're looking at a fierce battleground between buyers and sellers. At the bottom, our crucial support level sits right at $60,000. This is the psychological floor. Literally, every time the price dips near here, buyers step in aggressively to defend it. Currently, we're stabilizing in the 62,000 plus range, holding above major moving averages, which is great because it keeps the short-term bullish trend intact. But looking up, we hit a brick wall of resistance between $64,000 and $66,000. That ceiling is exactly where sellers are currently taking their profits, making it the absolute key zone to conquer if we're going to see any sustained rally towards $70,000.
So Bitcoin is essentially wedged in this incredibly tight consolidation phase. It's completely trapped between that major support floor and the immediate resistance ceiling. When a market gets squeezed like this, it's basically taking a deep breath. It's building a base and just waiting for a fundamental catalyst to spark enough volume to finally break through that upper resistance line. But remember, Bitcoin doesn't exist in a vacuum. Global macroeconomic conditions are very firmly in the driver's seat right now. Things like persistent global inflation, central bank interest rate decisions, and sudden geopolitical tensions like the recent developments between the US and Iran, they all heavily dictate investor risk appetite. If traditional markets get spooked, that ETS money could easily hit pause. On the flip side, if long-term holders simply refuse to sell and those institutional flows continue to accelerate, well, that supply shock could drive prices rapidly upward. Which brings us to our final thought for this explainer. We've looked at the flawless, hard-coded mathematical engine that secures Bitcoin, and we've seen Wall Street suddenly pouring hundreds of millions of dollars into it as a strategic asset. So the big question is this. Amidst all this global economic uncertainty and geopolitical tension, will Bitcoin's decentralized, immutable design be exactly what traditional investors are looking for to provide the momentum needed to smash through that $64,000 resistance? Keep a close eye on those ETF flows and those key technical levels in the days ahead. Thank you so much for joining me to unpack all of this, and as always, keep learning.